Within just a few trading sessions, gold pierced the $4,500 level, while silver fell back to $72, marking one of the sharpest declines in decades. Yet at the same time, physical silver in Shanghai continued to trade near $100. The same metal on the same day with a price divergence approaching 40%. This is not a matter of interpretation or opinion. It is observable market data. The question then is what is truly unfolding beneath the surface, not only in the US dollar and the paper markets, but in the evolving monetary role of gold and silver themselves. And, ultimately, what does this breakdown reveal about the valuation of your money? At this very moment, as this video is being played, the market is not static. Price screens continue to shift incrementally, tick by tick, yet the underlying sensation is anything but incremental. What is being felt is the strain of a system under pressure, not imposed externally, but generated by the internal mechanics through which it operates. There are no emergency alerts, no dramatic policy announcements dominating headlines, and yet prices continue to drift lower. It is precisely this absence of overt signals, this silence, that seasoned observers recognize as abnormal. In conventional market corrections, price action is usually accompanied or quickly followed by a narrative, an inflation print, a central bank statement, a recalibration of interest rate expectations. This episode deviates from that pattern. Here, price moved first, explanation followed later. When price precedes narrative, it often indicates that markets are no longer responding to information, but to constraint, to pressure embedded within the system itself. Crucially, this pressure does not originate from a collapse in demand for gold or silver. Rather, it stems from liquidity, and more precisely, from the US dollar. When margin requirements are adjusted over compressed timeframes, when positions constructed under conditions of relative ease are suddenly forced to exist within a far more restrictive environment, the market is compelled to respond in its most primitive form: liquidation for survival. At this stage, participants are no longer evaluated by conviction or outlook, but by a single immediate question: whether sufficient cash is available now. This transition from a market governed by belief to one governed by financial obligation is what produces the abrupt downward velocity. It also generates a distinctive psychological sensation familiar to those who have experienced prior episodes of systemic stress. The sense that the ground has not disappeared, yet no longer feels stable beneath one's feet. There is no singular dramatic collapse, only a sequence of continuous slippages, each preventing participants from fully re-establishing orientation. Yet a view limited to price screens in New York or London captures only part of the picture. Simultaneously, in markets where metal physically changes hands, an entirely different rhythm emerges. Physical silver does not mirror the paper response. It neither surges nor collapses. It holds. In commodity markets, the ability to hold price while surrounding instruments are declining is not neutrality. It is a signal of considerable strength. This divergence introduces a persistent, almost palpable tension. A single metal is now being priced through two distinct frameworks. One reflects financial stress and balance sheet pressure. The other reflects physical demand rooted in production, inventory, and supply chain realities. One operates through contracts, leverage, and margin. The other through logistics, storage, and industrial necessity. When these two domains cease to speak the same language, markets enter territory where conventional valuation models begin to fail. This is where the analytical lens of this channel shifts. Rather than asking what the correct price should be, the more meaningful inquiry becomes: which market is absorbing the greater pressure and why? Paper prices are expressing immediate dollar scarcity. Physical prices are expressing metal demand that cannot be deferred. These forces do not neutralize one another. They coexist, and in doing so, they generate divergence. Placed within the broader monetary framework, the pattern becomes clearer. In every period of financial stress, the US dollar occupies a central role. Not because it represents absolute safety, but because it functions as the final unit of settlement. When liquidity is required, capital pathways converge toward dollars. As a result, other assets, including traditional hedges, are temporarily displaced, regardless of their long-term role. History confirms that this dynamic is not anomalous. In 2008, gold and silver were likewise liquidated during the initial phase of crisis, not due to a loss of intrinsic value, but because markets required cash to meet obligations. Only after liquidity pressures subsided did their defensive characteristics reassert themselves. What differentiates the current episode is the simultaneous resilience of physical pricing, suggesting that foundational demand has not been extinguished. Another structural element, less frequently discussed yet materially significant, is the movement of metal out of centralized vaulting systems. This is not grounds for extreme inference, but it is a data point that must be contextualized correctly. When metal exits storage, it is no longer immediately available to reconcile delivery obligations within the financial architecture. This does not precipitate crisis instantaneously, but it erodes an already strained buffer. In complex financial systems, crises rarely emerge from a shortage of assets themselves. They arise from a breakdown in coordination between contractual commitments and operational reality. When commitments are built on assumptions of abundant liquidity, yet conditions shift toward tightening, the system must adapt, either by altering rules or by accepting elevated volatility. This fragility becomes more visible when considered alongside policy signaling and information flow. Ambiguous guidance, technical adjustments in trading mechanics, or even unverified reports can act as catalysts, not because of their intrinsic importance, but because the system has become hypersensitive. When safety margins compress, markets no longer require perfect information to react forcefully. At this juncture, it is critical to distinguish analysis from prediction. This discussion does not aim to forecast price direction, nor to construct deterministic scenarios. Its purpose is to examine the evolving relationship between the US dollar, foreign currencies, gold, and silver as risk is being repriced. The recent decline illustrates that, in the short term, systemic functionality is prioritized over long-term value expression. Yet it also demonstrates that physical value does not vanish. It is merely displaced from the zone of maximum pressure. What renders this phase particularly significant is not the drama of price movement, but the sense that the system is revealing its underlying structure. Elements once obscured by abundant liquidity are becoming visible. For observers, the real value lies in recognizing the phase of the cycle being traversed, rather than reacting to each numerical fluctuation. If you have followed the discussion this far, you likely sense that tension as well. Not blind panic, but heightened alertness. The market appears to be signaling, do not focus solely on price. Examine the mechanism by which price is formed. This is where the discussion gains relevance. What do you observe in these developments? Do they primarily reflect short-term liquidity stress, or do they indicate a deeper structural divergence between paper assets and physical assets? Grounded perspectives sharpen the picture, not through emotion, but through understanding. This brings us back to the question posed at the beginning. If prices are falling so sharply, what is truly being repriced? This is precisely why this crash matters more than the figures displayed on a screen. It reflects not merely short-term volatility, but the behavior of the monetary system when political, fiscal, and liquidity pressures converge simultaneously. Throughout monetary history, gold and silver have served to preserve purchasing power when confidence in layers of paper claims is tested, not instantaneously, but cyclically. What we may be witnessing, therefore, is not an endpoint, but a phase of systemic adjustment preceding broader shifts ahead. This may represent only the opening stage of a longer repositioning process in the quarters to come. How do you think this will influence the US dollar, foreign currencies, and the evolving role of gold and silver in an era defined by technology and global competition. This is Money Cycles. We do not chase headlines. We examine the structure beneath them. And if you want to follow what is forming next,